Most people believe the financial system rewards effort. Work hard, be loyal, climb the ladder, retire comfortably. That is the promise. But here is the uncomfortable question almost nobody asks. If the system truly rewarded effort, why are millions of the hardest working people financially stuck for decades? People wake up at 6 a.m., commute through traffic, work 8, 10, sometimes 12 hours a day, pay their bills, save what little remains, and yet, somehow, year after year, the distance between them and real financial freedom barely moves. This is not a motivation problem. This is not a discipline problem. And this is not about intelligence. In fact, some of the most intelligent people on Earth are deeply embedded inside the same trap. Engineers, doctors, corporate managers, highly educated professionals, all running inside a system that looks stable on the surface, but behaves very differently underneath. Because what most people think is a career path is actually something else entirely. A loop. A repeating economic cycle that quietly governs how income flows, how expenses expand, and how time is exchanged for survival. Think of it like a treadmill in a laboratory experiment. From the outside, the subject appears to be moving forward. But from a structural perspective, they are running in place. The system isn't designed to stop them from moving. The system is designed to ensure they never move far enough to exit. And once you understand how this loop works, something disturbing becomes visible. The trap doesn't rely on force. It relies on structure. Invisible architecture that slowly locks people into a predictable economic pattern. Earn, spend, adjust lifestyle. Repeat, year after year, after decade, until eventually the realization arrives quietly somewhere in middle age. I've been working for 20 years, and I'm still dependent on my next paycheck. This silent anxiety sits beneath the surface of millions of lives, not dramatic enough to trigger panic, but persistent enough to create a constant low-grade pressure, a feeling that something about the system doesn't quite add up. And the truth is, that instinct is correct, because beneath the modern employment system lies a set of economic mechanics most people never see. Mechanics that determine who stays in the employee loop and who eventually breaks out of it. These mechanics behave less like career advice and more like physics, forces, friction, momentum. Once the loop begins, each year reinforces the structure. Expenses increase, responsibilities expand, risk tolerance shrinks. And gradually, escape becomes harder not because people are weak, but because the system tightens around them. This is why millions of capable, disciplined individuals remain financially trapped despite doing exactly what society told them to do. They followed the rules, they played the game, but they were never shown the board. And once you finally see the board, the entire structure of modern work starts to look very different. Because the employee loop is not random. It is predictable. It is mathematically reinforced. And once someone enters it early in life, it quietly shapes every major financial decision that follows. Career choices, housing decisions, spending behavior, risk tolerance, even identity itself. The question is no longer why people work. The real question is something far more unsettling. Why is it so difficult to stop? Because hidden inside this loop are several powerful psychological and financial mechanisms that most people never notice until it's far too late. And the first of those mechanisms is buried deep inside the invisible architecture of the modern income system. That's where the structure finally reveals itself. And once you see it, you will never look at employment the same way again. Most people think employment is a financial solution. In reality, it is a financial structure. And like any structure, it was built with specific mechanics that determine how money flows, how risk is distributed, and how time is exchanged for survival. This is the first shift most people never make. They believe their job is simply a transaction, time to salary. But beneath that simple equation sits an entire economic architecture quietly shaping their financial trajectory. Because employment is not just income, it is a containment system for income. And this is where the structure begins to reveal itself. In physics, energy flows from areas of higher potential to lower potential. Money behaves in a strangely similar way. But within the employee loop, the direction of that flow becomes tightly controlled. Think about the typical life progression most people follow. First comes education. For nearly 2 decades, individuals are trained to acquire knowledge and develop skills. The narrative is clear. Learn enough, work hard enough, and eventually you will secure stability. Then comes the first job. At this stage, the income feels transformative. The first paycheck creates a sense of independence. Financial momentum appears to begin. But something subtle happens immediately afterward. Income rises slightly. Expenses appear. And the loop quietly begins. Rent, transportation, food, insurance, taxes. What initially feels like freedom slowly converts into obligation. And from that point forward, the architecture tightens. Every month becomes a reset point. Income arrives. Expenses absorb it. The cycle repeats. This is not accidental. The modern financial ecosystem is designed around predictable income absorption. Housing markets expect steady salaries. Consumer credit models expect steady salaries. Car loans, mortgages, insurance systems, tax systems. They all rely on predictable monthly income streams. Employees provide exactly that. Consistency, reliability, unpredictability, which makes them the most stable financial participants in the entire economic system. But stability for the system often means stagnation for the individual. Because once someone's life becomes calibrated to a monthly salary, flexibility begins to disappear. And this is where the invisible constraint appears. A person earning $60,000 per year does not simply earn money. They build an entire life structure around that income level. Housing adjusts to it. Transportation adjusts to it. Social expectations adjust to it. Financial commitments begin to anchor around it. And suddenly, the salary is no longer just income. It becomes a gravitational center. Everything orbits it. Now imagine increasing that salary from $60,000 to $80,000. On paper, this looks like progress. But something else tends to rise at the same time. Lifestyle. A slightly better apartment. A newer car. More frequent dining out. Small upgrades that feel justified after years of effort. And none of these decisions appear reckless. In fact, they often feel responsible. After all, the individual worked hard to earn more. But here is the subtle trap most people never see. Each lifestyle upgrade quietly raises the cost of remaining inside the system. Financial escape becomes harder, not easier. The employee loop strengthens. Because the more comfortable the structure becomes, the more dangerous disruption begins to feel. Leaving a job suddenly carries higher stakes. Experimenting with income becomes riskier. Exploring new financial models feels irresponsible. This is why the loop rarely breaks through dramatic failure. It breaks through structural awareness, because once someone sees the architecture clearly, a disturbing realization emerges. The system does not need to trap people aggressively. It only needs to keep them comfortable enough to stay. While comfort becomes containment, security becomes dependency, and gradually, an entire generation of capable, disciplined individuals begins orbiting around a single economic model: work to salary to expenses to repeat, year after year, after decade. But something even more powerful operates inside this structure. A psychological shift that quietly removes personal shame from the equation. Because once you see the system clearly, you realize something critical. Most people inside the employee loop are not failing. They are behaving exactly as the structure expects them to behave, which raises a much deeper question. If the system predicts these outcomes so accurately, then what else is influencing the decisions people make with their money? Because the next layer of the trap isn't structural, it's behavioral. And this is where the loop tightens in ways most people never notice. Once the structural architecture of the employee loop is understood, a deeper layer begins to emerge. Structure alone does not keep millions of people inside the loop. If it did, more individuals would eventually rebel against it. But most don't. Instead, they participate willingly, even enthusiastically. And the reason lies in a powerful intersection between behavioral finance and identity psychology. Because the employee loop does not simply manage money, it manages human behavior. But this is where the system becomes far more sophisticated than most people realize. To understand it, you must first recognize a fundamental truth about human decision-making. People rarely make financial decisions based on logic. They make them based on emotion, identity, and social comparison. And the modern economic environment is perfectly engineered to activate all three. Consider the moment someone receives their first meaningful salary increase. On paper, this should represent a powerful opportunity. Higher income creates the possibility of saving, investing, and building financial leverage. But something else often happens instead. The mind performs a subtle psychological calculation. Not, how can this money build long-term freedom? But, what does someone at my income level typically live like? This is the moment identity spending begins. A slightly better phone, a more stylish wardrobe, an upgraded apartment, and maybe a car that reflects professional success. None of these purchases feel reckless. They feel socially aligned, because humans are not wired to evaluate wealth in absolute terms. We evaluate it relative to the people around us. This behavioral bias is known in economics as status signaling, and it plays a crucial role inside the employee loop. Because status signaling quietly converts income into visible consumption. Money that could become assets becomes proof of success. But this is why high-income professionals often remain financially fragile. Doctors earning six figures still carry massive debt. Corporate executives struggle with lifestyle inflation. Even individuals with elite salaries can remain dependent on monthly paychecks. From the outside, they appear successful, but internally, their financial structure remains fragile. Because the loop has shifted from survival to identity maintenance. And identity maintenance is incredibly expensive. Then a person who sees themselves as successful begins to unconsciously defend that identity through spending patterns. The nicer apartment becomes part of the identity. The luxury car reinforces the identity. The expensive social environment sustains the identity. Suddenly, reducing expenses begins to feel like losing status. And the loop tightens further. This is where emotional spending triggers enter the system. Stress, fatigue, workplace pressure. Some modern employment often creates psychological exhaustion. Long hours, demanding deadlines, and constant performance evaluation slowly drain cognitive energy. And when cognitive energy drops, financial discipline tends to weaken. Behavioral economists call this decision fatigue. When people are mentally exhausted, they default to easier choices. Convenience purchases increase. Impulse spending rises. Long-term planning disappears. Short-term relief becomes the priority. Which explains something strange about the employee loop. The very system that demands discipline also creates the emotional conditions that erode it. Work stress fuels spending. Spending increases financial pressure. Financial pressure reinforces dependence on the job. The loop feeds itself. But perhaps the most powerful behavioral trap is something far more subtle. Social comparison. Humans evolved inside small tribes where status determined survival. Today, that same psychological mechanism operates inside offices, neighborhoods, and digital social networks. We measure progress by looking sideways. Who has the better house? Who took the better vacation? Who drives the nicer car? And slowly, without realizing it, financial goals shift. Instead of pursuing freedom, people pursue appearance. And appearance is endlessly expensive. Because no matter how much someone earns, there will always be someone earning more, someone living bigger, and someone displaying greater success. So the spending escalates. But the real damage is not just financial, it is strategic. Because every dollar spent on maintaining social identity is a dollar that cannot be deployed toward asset creation. And asset creation is the only force capable of breaking the employee loop. This is why many intelligent individuals remain stuck despite high incomes. They are not failing financially, and they are participating in a behavioral game they were never taught to question. But beneath the psychology lies an even more unforgiving force, the mathematics of the system. Because when income, expenses, and time begin interacting across decades, a very precise pattern begins to appear. A pattern that determines who eventually escapes the loop and who remains inside it for life. Once you see those numbers clearly, the entire illusion of financial progress begins to collapse. Light psychology explains why people behave the way they do inside the employee system. But mathematics explains something far more important: why the system is so difficult to escape once time passes. Because the employee loop is not just psychological or structural. It is mathematically reinforced. And mathematics is unforgiving. It does not care about intentions, intelligence, or work ethic. It only responds to inputs, income, expenses, time, and most importantly, capital. This is where the financial game quietly separates into two completely different worlds: the income world and the capital world. Most employees spend their entire lives operating inside the income world. They earn, they spend, they save a little, they repeat. But wealth does not primarily grow inside the income world. Wealth grows inside the capital world. And the difference between the two is not small. It is exponential. Let's look at a simple model. Imagine two individuals beginning their careers at age 25. Both earn $60,000 per year. Both receive modest raises. Both work hard. But their financial behaviors differ slightly. Person A saves small amounts, but primarily upgrades lifestyle as income rises. Person B channels increasing income into assets. At first, the difference is invisible. In year one, both lives look almost identical. Similar apartments, similar spending, similar daily routines, but beneath the surface, a silent divergence begins. Person A's money flows outward into consumption. Person B's money flows into capital accumulation. And capital behaves differently than income. Income grows linearly. Capital grows exponentially when invested correctly. Consider a simple compounding framework. If $10,000 is invested at an average return of 8% annually, something interesting happens. Year 1, $10,800. Year 5, $14,693. Year 10, $21,589. Year 20, $46,610. Year 30, $100,626. Notice something important. The first decade feels slow. The second decade accelerates. The third decade explodes. This is the hidden engine behind wealth. Compounding velocity. But here is the brutal truth inside the employee loop. Most people never accumulate enough capital early enough for compounding to matter. Their financial energy is absorbed by lifestyle costs long before capital reaches critical mass. And without critical mass, compounding remains theoretical. This creates what economists call a capital threshold, a level of invested assets where growth begins to meaningfully influence financial independence. Below the threshold, progress feels slow. Above the threshold, momentum builds rapidly. But crossing that threshold requires something most employees struggle to maintain: surplus capital. Not just savings. Strategic surplus. Money that is not immediately required for survival. A money that can be deployed into assets without threatening daily stability. And here lies the structural problem. The employee loop compresses surplus because salaries increase gradually, but expenses tend to adjust quickly. Rent expands, transportation upgrades, lifestyle evolves, so the surplus window remains narrow. Even high earners often discover something shocking. A $120,000 salary does not automatically produce financial freedom. Because if expenses rise to $100,000 per year, the surplus remains fragile, which means capital growth remains slow. And slow capital growth delays the compounding curve. But something else happens inside this mathematical system. Something few people calculate. Wealth velocity measures how quickly assets begin generating meaningful financial independence. And velocity is heavily influenced by three variables: capital size, return rate, time horizon. Employees usually optimize only one variable: income. But income alone cannot accelerate wealth velocity unless it converts into deployable capital. This is why some entrepreneurs surpass lifelong employees financially within a decade. Not because they are inherently smarter, but because their financial model allows capital accumulation at much higher speeds, more capital deployed earlier, more time for compounding, higher velocity. Meanwhile, the employee loop continues operating on a predictable rhythm. Salaries, expenses expand, surplus remains small. Time passes, and this is where the mathematics becomes quietly terrifying. Because time is not neutral inside financial systems. Time amplifies whatever structure already exists. If capital compounds, time becomes an ally. If capital stagnates, time becomes a silent limiter. The decades can pass with minimal financial transformation, which leads to a painful realization many people face in their 40s or 50s. They worked consistently for 20 years. They increased income gradually. They made responsible financial choices, and yet, their capital base remains too small for compounding to generate freedom. This is where the illusion of progress collapses. But the numbers alone do not explain everything. Because even when intelligent people understand the mathematics, many still fail to change the trajectory. Which raises another question. If the math is visible, why do so many capable individuals remain stuck in the loop? The answer lies in something even more powerful than structure or numbers. And this is where the system exerts its strongest pressure. At this point, the mechanics of the employee loop should be visible. The structure absorbs income. Behavioral triggers redirect capital toward consumption. Mathematics quietly delays financial escape. Yet a disturbing question remains. If intelligent people can understand these forces, why do so many still remain trapped? Because intelligence alone does not defeat a system, especially when that system is reinforced by social programming. And social programming is one of the most powerful forces shaping financial outcomes. It begins early, from long before anyone earns their first paycheck. From childhood, most people are given a very specific narrative about work and security. Study hard, get good grades, find a stable job, work consistently, climb the ladder. This story is repeated by parents, teachers, institutions, and entire cultural environments. And on the surface, it appears rational. Stability is valuable. Income is necessary. But this narrative also embeds a powerful assumption that employment is not just one path, but the primary path to financial stability. So most individuals never question it. They optimize within it. Better degree, better job, better salary, better company, but the framework itself remains untouched. This is why the employee loop can persist across generations, not because people lack intelligence, but because the system has been normalized for so long that it feels natural. Think about the psychological pressure surrounding career decisions. A young graduate rarely feels encouraged to pursue uncertain financial experiments. Risk is discouraged. Stability is rewarded. Parents worry about security. Friends follow similar career tracks. Society praises predictable success. And slowly, the environment begins shaping financial behavior. Because humans are profoundly influenced by environmental expectations. Even highly independent thinkers absorb social signals. When everyone around you follows the same financial model, deviation begins to feel dangerous, which leads to one of the most underestimated forces inside the employee loop. Lifestyle anchoring occurs when someone's living standard becomes psychologically fixed. The apartment, the car, the social circles, the routines, all of these become part of daily life. And once a lifestyle becomes normal, moving backward becomes emotionally difficult. Not because survival is impossible, but because identity begins to attach itself to comfort. Imagine someone earning $90,000 per year. They rent a comfortable apartment. They lease a nice car. They dine out regularly. They travel occasionally. From the outside, life looks balanced. But beneath the surface, something fragile is forming. the monthly cost of maintaining that life quietly rises. Rent, insurance, subscriptions, on debt payments, daily conveniences. Each one seems manageable individually, but collectively they create something powerful. Financial inertia. Financial inertia means the system resists sudden change. Even if someone wants to pursue a new opportunity, reduce work hours, or explore entrepreneurship, the cost of disruption suddenly feels enormous. Because the lifestyle must still be funded, this is why intelligent people often delay financial transformation, when not because they cannot understand the opportunity, but because the risk of losing stability feels greater than the reward of gaining freedom. And the longer someone stays inside the employee loop, the stronger this inertia becomes. Responsibilities increase. Families form. Mortgages appear. Health insurance becomes necessary. Suddenly, the system is no longer just about personal decisions. It becomes about protecting others. This is where the loop becomes extremely powerful, because it converts financial caution into long-term dependency. People become responsible. Responsible people avoid large risks. Avoiding large risks keeps them inside predictable income structures. Predictable income structures reinforce the employee loop. And the cycle continues. But there is another hidden factor that quietly drains financial energy from even the most disciplined individuals. Decision fatigue. Economics. Modern employees make hundreds of decisions every day. Work problems, deadlines, emails, meetings, personal responsibilities. By the end of the day, cognitive energy is depleted, and financial strategy requires clear thinking, long-term planning, investment research, risk evaluation, capital deployment. But when the mind is exhausted, those decisions are postponed. Tomorrow becomes next month. Next month becomes next year. And slowly, financial strategy disappears beneath the noise of daily survival. Or this is why the employee loop does not collapse quickly. It persists quietly. Years pass without dramatic crisis. People earn, they spend, they upgrade slightly, they maintain stability, and stability creates the illusion of progress. Till one day, a realization arrives unexpectedly. The career is mature. Income is respectable. But true financial freedom still feels distant. This is the moment many people finally begin asking a different question. How do I earn more? But, how do I build a financial structure that no longer depends entirely on employment? Because escaping the employee loop requires something far more deliberate than simply working harder. It requires architecting an entirely different financial system, a system built around capital, assets, and strategic asymmetry. And this is where the real transformation begins, because once someone understands how to construct that structure, the employee loop stops being a life sentence. It becomes a temporary phase, but the blueprint for that transition is rarely taught. And the few who understand it follow a very different financial strategy, one that unfolds step by step, one that changes the entire direction of money flow. And once that blueprint is understood, the path out of the loop finally becomes visible. Once someone sees the employee loop clearly, a dangerous misunderstanding often appears. They assume the solution is simply quitting the job. But that is not strategy. That is reaction. And reaction without structure usually creates something worse than the loop itself: financial chaos. The objective is not to escape employment emotionally. The objective is to replace dependency with architecture. Because financial freedom is not an event. It is a system. And every durable system is built from several coordinated layers: income, capital, assets, skills, risk control. When these layers operate together, money begins behaving very differently. Instead of flowing outward toward consumption, it begins forming self-reinforcing capital engines. This is where the strategic blueprint begins. Not with dramatic change, but with a quiet, structural shift. Step 1. Capital stabilization before assets can grow. Capital must survive. This sounds obvious, yet most people skip this phase entirely. Their finances remain fragile. One unexpected expense can wipe out savings. This fragility forces dependence on salary. So the first structural layer is simple but powerful. Build a financial buffer large enough to absorb disruption. 6 months of essential living costs. Not luxury costs. Not lifestyle costs. Essential costs. This buffer creates something extremely valuable: time. And time is the first ingredient required to redesign a financial life. Without time, every decision becomes defensive. With time, strategy becomes possible. But stabilization alone does not break the loop. The next layer begins shifting money toward power. Step 2. Surplus engineering. Most people treat surplus as accidental. Whatever remains at the end of the month becomes savings. But strategic individuals reverse the process. Surplus becomes pre-planned capital allocation. Now income arrives. A percentage is immediately redirected toward asset acquisition, not after spending, before spending. This creates a subtle but powerful effect. Lifestyle begins adjusting downward to protect capital, rather than capital shrinking to support lifestyle. And once surplus begins accumulating consistently, the blueprint enters its most critical phase: asset acquisition logic. Not all assets behave equally. Some produce income, some produce appreciation, some produce both. The objective is not simply owning assets. The objective is constructing a cash flow architecture. Assets that generate recurring financial energy. Dividend-producing equities. Income-producing businesses. Rental properties. Digital assets with recurring revenue models. The specific asset class matters less than the underlying principle. Money must begin working independently of time. Because as long as income requires continuous personal effort, the employee loop remains intact. This is where patience becomes strategic. Asset income grows slowly at first. In fact, the early stages often feel frustratingly small. A few $100s, then perhaps 1,000, then several thousand, annually. But something critical is happening beneath those modest numbers. Dependency begins weakening. Each dollar of external income reduces reliance on salary. Each new asset expands financial optionality. This is how the loop begins to loosen. But there is another layer most people underestimate: skill stacking. Assets require intelligent management. Markets shift. Opportunities evolve. And individuals who build wealth rarely rely on a single skill. Instead, they combine multiple competencies that amplify each other: financial literacy, negotiation, market analysis, opportunity recognition, digital leverage, strategic thinking. When these skills intersect, individuals begin seeing opportunities invisible to others. Since suddenly, the world looks different. Instead of only seeing jobs, they begin seeing systems capable of producing capital. But even this blueprint requires protection. Because capital growth introduces new risks: market volatility, overconfidence, leverage misuse. Which is why the next structural layer is essential. Risk mitigation architecture, diversification across assets, avoiding excessive leverage, maintaining liquidity, protecting downside exposure. The objective is not maximizing short-term gains. It is preserving long-term asymmetry. Asymmetry means potential upside greatly exceeds potential downside. Small losses, large gains, repeated consistently over time. This approach changes the entire psychology of money. Instead of chasing income, individuals begin deploying capital strategically. Instead of reacting to financial pressure, they design systems that generate optionality. And gradually, something extraordinary happens. Income from assets begins covering portions of life previously funded by salary. First, small categories: groceries, utilities, insurance, then larger categories: housing, transportation. Eventually, something remarkable occurs. The salary that once sustained life becomes supplemental rather than essential. At that moment, the employee loop begins losing its power. Because the individual now possesses something extremely rare: financial autonomy. The freedom to choose work rather than depend on it. But even with a solid capital blueprint, the process can take decades without acceleration. And this is where the next phase begins. Because certain financial strategies dramatically increase the speed of wealth formation. A phase where income and assets begin working together simultaneously. A phase where financial momentum compounds faster than most people believe possible. But this is where the escape velocity from the employee loop truly begins. Once the strategic wealth blueprint is in place, something subtle but powerful begins to happen. The individual is no longer operating purely inside the employee loop. But they are not free yet either. They are standing in a transition zone, a place where income still matters. But capital has begun forming its own momentum. Now, this is the phase where wealth formation either accelerates dramatically or stalls for another decade. Because escaping the loop is not just about building assets, it is about increasing financial velocity. And velocity requires two engines operating at the same time, not one. This is where most people misunderstand the path. They assume the goal is to replace employment with assets as quickly as possible. But the individuals who escape fastest follow a different model. They operate a dual-engine system. Engine 1, income expansion. Engine 2, asset acceleration. Both run simultaneously. And when these engines synchronize, something unusual happens. Financial progress stops feeling linear. It begins behaving more like a chain reaction. Income increases leads to more capital available. More capital leads to more assets acquired. More assets leads to additional income streams. Additional income leads to even more capital deployment. And the cycle begins feeding itself. So this is the moment the employee loop starts weakening structurally, because the individual is no longer relying on one economic channel. They are building multiple financial pathways. But acceleration requires more than effort. It requires optionality. Optionality means maintaining the flexibility to move when opportunities appear. And opportunities in financial systems rarely arrive evenly. They appear in windows, market downturns, emerging industries, technological shifts, asset mispricing. When these windows open, individuals with available capital can move quickly. Those without capital remain spectators. This is why liquidity matters so much during the acceleration phase. Cash is not idle. Cash is strategic ammunition. It allows individuals to deploy capital when fear dominates the market, to acquire assets when others are forced to sell, to take calculated risks when opportunities briefly become asymmetric. But acceleration introduces a dangerous temptation: leverage. Leverage is the use of borrowed resources to amplify financial outcomes. Used intelligently, leverage can accelerate wealth formation dramatically. Used recklessly, it can destroy years of progress in a single downturn. This is where disciplined individuals separate themselves from speculative gamblers. They understand a simple rule: leverage should magnify strong systems, not compensate for weak ones. In other words, if an asset cannot generate reliable returns without leverage, it becomes extremely dangerous with leverage. This principle protects the acceleration phase from catastrophic setbacks, because the objective is not explosive growth. The objective is controlled momentum. Momentum that compounds across years without major reversals. But acceleration also introduces a psychological transformation. As assets grow, something interesting happens to time perception. That employees typically think in monthly cycles, paychecks, bills, budgeting periods. But capital operators begin thinking in strategic timelines: 5-year positioning, 10-year asset horizons, market cycles, economic shifts. Their financial decisions begin stretching across decades rather than months. This shift changes how opportunities are evaluated. Short-term volatility becomes less frightening. Temporary downturns become acquisition opportunities. And patience becomes a strategic advantage. But perhaps the most powerful outcome of the acceleration phase is something rarely discussed: power over personal time. When asset income begins covering meaningful portions of living expenses, the psychological relationship with employment changes. The job no longer feels like survival. It becomes a strategic choice. Some individuals continue working to expand capital. Others reduce hours. Some begin launching businesses or creative ventures. But the crucial shift is this: work becomes optional. And optional work operates under completely different psychological rules. Confidence rises. Negotiation power increases. Risk tolerance improves, because financial collapse is no longer one decision away. This is the moment the employee loop finally begins losing its gravitational pull. But something even deeper must occur before true escape becomes permanent. Because financial transformation is not only external, it is internal. Without a corresponding psychological evolution, many individuals unconsciously sabotage their own progress. They revert to old habits. They inflate lifestyle too quickly. They abandon discipline once income rises. Which is why the next phase of escaping the employee loop is not financial at all. It is identity evolution. A complete shift in how a person sees money, time, and their role within economic systems. And without that transformation, even successful individuals can find themselves drifting back into the very loop they worked so hard to escape. Up to this point, the transformation out of the employee loop appears financial: capital accumulation, asset systems, income diversification. But beneath all of those mechanics lies something far more decisive: identity. Because the employee loop is not only an economic structure, it is also an identity framework. For most of their lives, people are conditioned to define themselves through employment. What do you do? This question is so common, it feels harmless. But notice what it actually measures. It does not ask how you think. It does not ask what systems you build. It does not ask what capital you control. It asks what role you perform inside the economic machine. And over time, individuals internalize that role. Teacher, engineer, manager, consultant. These titles slowly merge with personal identity, which means leaving the employee loop is not simply a financial transition. It is a psychological reconstruction, because once someone begins building assets and capital systems, their relationship with work begins to change. At first, the shift feels subtle. The job still exists. The salary still arrives. But mentally, something different happens. The individual no longer sees employment as the foundation of their financial survival. It becomes one strategic component among many. This shift might sound small, but internally, it rewires decision-making. Employees optimize for stability. Capital operators optimize for asymmetric opportunity. Employees think in terms of salary increases. Capital operators think in terms of system scalability. Employees measure success through promotions. Capital operators measure success through ownership and leverage. These mental models create radically different financial trajectories. But making that shift requires confronting one of the most difficult psychological barriers humans face: delayed gratification. The employee loop rewards short-term effort with short-term reward. Work this month, receive salary next month. This creates a tight feedback cycle. Effort to reward. But capital systems behave differently. Assets often require years before meaningful returns appear. Investments may look stagnant for long periods. Businesses might take time to reach profitability. This delay creates discomfort. And the human brain naturally resists discomfort, which is why many individuals abandon long-term strategies prematurely. They revert to the immediate certainty of salary. But those who successfully escape the loop undergo a mental rewiring. They begin seeing time differently, not as something to trade for income, but as an amplifier of well-designed systems. When this shift happens, patience stops feeling like sacrifice. It becomes strategic leverage, because the individual understands that every year assets remain active, compounding quietly multiplies their impact. But identity evolution requires another change: strategic detachment. Employees often become emotionally attached to institutions, companies, titles, career paths, performance recognition. These attachments can create powerful loyalty. Yet loyalty can also become a constraint, because institutions ultimately operate according to their own incentives. A company exists to maximize organizational performance, not individual financial independence, which means strategic individuals learn to maintain professional excellence while avoiding emotional dependency. They perform well. They contribute value, but internally, they remain focused on their own financial architecture. This detachment allows clearer thinking, as career decisions become strategic rather than emotional. Time allocation becomes deliberate. Energy begins flowing toward systems that build long-term autonomy. And gradually, something extraordinary happens. The individual stops thinking in terms of months or even years. They begin thinking in decades, 10-year capital strategies, 20-year asset accumulation horizons, generational wealth planning. This long-range perspective changes everything. Short-term noise becomes irrelevant. Temporary setbacks lose emotional weight, because the focus has shifted toward structures that compound over long periods. And this is when the final transformation begins, the moment when wealth itself must be redefined. Because if someone escapes the employee loop, but still measures success using the same outdated definitions of money and status, they risk building a different kind of cage. A larger one, but still a cage. Which means the final step in this journey is not simply financial independence, it is something deeper. A new understanding of what wealth actually means, and why the most powerful forms of wealth often have nothing to do with visible income at all. By the time someone reaches this stage, the employee loop is no longer invisible. They understand the structure. They understand the psychology. They understand the mathematics. They have built assets. They have developed financial optionality. But a final transformation still remains, because escaping the employee loop is only half the journey. The other half requires redefining what wealth actually means. And this is where many people make a critical mistake. They escape the employee system, only to rebuild another form of captivity. A larger house, more expensive cars, more visible success, more consumption disguised as achievement. From the outside, it looks like victory. But internally, the structure is familiar. Higher expenses, greater obligations, more complexity. In other words, the loop returns, just at a higher income level. This is why wealth must eventually be redefined beyond income and consumption. Because income alone does not create freedom. Income only creates capacity. Freedom depends on how that capacity is structured, which leads to the first redefinition. Wealth is not income. Wealth is control over time. A person earning $200,000 per year but unable to stop working remains financially dependent. A person earning far less but supported by stable assets may possess far greater autonomy. This difference is rarely visible, but it changes everything. Time autonomy means decisions are not dictated by survival pressure. Projects can be chosen intentionally. Work can be pursued for meaning rather than necessity. Opportunities can be explored without fear of immediate financial collapse. This is the first real layer of wealth. But there is a second layer even more powerful: psychological freedom. When financial systems are stable, mental bandwidth expands. Constant money anxiety disappears. Decision-making improves. Creativity increases. Long-term thinking becomes natural rather than forced. Most people underestimate how much mental energy financial instability consumes. It occupies attention, creates stress, distorts priorities. Which is why true wealth must include psychological stability, the absence of constant financial pressure. But even that is not the final layer. The most sophisticated capital operators eventually discover something deeper. Wealth is optionality. Optionality means having the ability to move when opportunity appears, to invest when markets panic, to relocate when circumstances change, to pursue projects without institutional permission. Optionality transforms the relationship between individuals and the economic system. Instead of reacting to the system, they navigate it strategically. And the more optionality someone accumulates, the less fragile their life becomes, because they are no longer dependent on a single income source, a single employer, a single geographic location, a single financial outcome. Multiple pathways exist. Multiple safety nets exist. And with that optionality comes a final realization. The employee loop was never just about employment. It was about dependency. Dependency on predictable income. Dependency on institutional structures. Dependency on systems designed primarily for stability rather than autonomy. Breaking that dependency requires capital. But sustaining freedom requires something more subtle: clarity. Clarity about what kind of life is actually worth building. Because the most powerful wealth is not visible. It does not appear in luxury purchases. It does not appear in status symbols. It appears in something much quieter. The ability to control your time. The ability to choose your work. The ability to build systems that outlive your personal effort. And once someone experiences that level of freedom, the entire concept of success begins to change. But understanding this intellectually is one thing. Living it is another, which is why every person who sees the employee loop clearly eventually faces a final decision. I continue drifting within the system, or begin constructing a life beyond it. And that decision leads to one final challenge. At this point, the structure is no longer hidden. You have seen the loop, the architecture that absorbs income, the behavioral triggers that redirect money toward consumption, the mathematics that quietly delay financial escape, the social programming that keeps intelligent people inside predictable paths. None of it required conspiracy. Only structure. And once structure becomes visible, something changes permanently. Because from this moment forward, every financial decision carries a new level of awareness. You will notice the loop when salary increases trigger lifestyle pressure. You will notice the loop when social comparison tries to redefine success. You will notice the loop when comfort begins disguising dependency. And the question will quietly return again and again. Am I reinforcing the system or redesigning it? Escaping the employee loop does not require dramatic rebellion. It requires deliberate architecture. Small capital decisions repeated consistently. Assets built patiently. Skills compounded over time. Identity evolving slowly but permanently. The transformation rarely looks spectacular in the beginning. In fact, for years it may look ordinary. Quiet investments, controlled spending, strategic thinking. But beneath that calm surface, something powerful is forming. Momentum. And momentum, once established, behaves differently than effort. Effort must be repeated daily. Momentum continues moving even when you pause. This is how financial independence truly forms, not through sudden windfalls, but through systems that grow stronger with time. The employee loop survives because most people never step far enough away from it to see its full design. But once someone sees it clearly, they face a simple but uncomfortable choice: continue trading decades for predictable income, or begin constructing systems that eventually make that trade optional. No one makes that decision for you. Not your employer, not the market, not society, because the system does not prevent escape. It only makes escape uncomfortable enough that most people never attempt it. But for those who do, time begins working in their favor. Capital begins multiplying quietly. Freedom begins expanding gradually. Until one day, something subtle happens. The paycheck that once defined survival becomes irrelevant. And the loop that once controlled your life becomes nothing more than a system you outgrew. The real question is no longer whether the employee loop exists. You have already seen it. The real question is much simpler. What will you build outside of it?